Okay.
Right. I don't know.
Welcome, capital W. Sorry? Welcome with a capital W.
Yeah.
Followed by 2, followed by in lowercase Axio.
Okay.
There we go.
Thank you.
Right. Let's get on with it. Okay, so as its entry and exit, and I know Alex online just asked a question, despite not being directly entry exit related, that is fine, we can cover it. So we shall do that. Then we were discussing this morning. It's something I was speaking to someone about yesterday as we were talking through a trade and the sort of execution and idea of it. So when it comes to entry and exit, I'll try and sort of talk you through the whole trade that we were going through yesterday, the thought process around it. So I think a lot of it is not just a case of, well, this is a place to enter or this is a place to exit. It's about the thought process once you're in the trade and what contributes to you then going, okay, I should do this, or I shouldn't do this, or I should get out, I should stay in. So we'll come on to all of this. But I'll start off by covering these couple of questions. Right. In the early days of sim trading, is it worth trading multiple contracts even if you don't have defined strategies yet? So you can practice scaling, pyramiding, or start with one until you start defining strategies. On a sim, the P&L doesn't matter. Trade whatever you've got. If you've got 6, trade 6. Don't trade all 6 in one go. Trade in multiples. That will massively help when you increase size later on. So let's say, for example, I know you guys have got 30 MES, which is micro S&P. You don't want to go trading one micro S&P. You will not make any money doing that. It's too small. It's $1.25 per price, so it's $5 per big tick. You're really going to struggle to make any money. You know, if you took the entirety of the day's range yesterday, you'd have just about made $250. I don't know anybody who's good enough to take the entire range out of the market, so you're going to struggle. The point here being, take your 30, and I would divide it by, take your 30, divide it by 5, and that gives you 6. So I would set my, what I would call clip at 6. So the little white box on your jigsaw, set that to 6. This way, when you go and take a trade on, you can look at your trade and ask yourself essentially a level of conviction. Is this worth all 5 clips? Is it worth 1, 2, 3, or 4, and variations of that? So this then allows you to either pyramid into a trade. It allows you to go, no, this is massive high conviction, just buy it and hit all 5, click, 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 click. You can make that decision. The whole idea behind this is when that's 300, that stays as 5, this is now 60. The process is exactly the same. That's the whole idea behind that type of approach of things. So when it comes to scaling your size up in future, you're not going, oh no, now I'm trading a 10 lot. You're not, you're trading whatever that total is divided into increments of 5, 10, whatever you decide you want to do it in. Quite a few people, certainly the more newsy based traders, may well, let's say, have 200 lots. And what they will actually do is they will have 5 clips of 20, which obviously doesn't make 200, and then they'll have another clip of 100. So the idea being, if there's news, they'll go to 200. If there's no news, their effective max size is 100. So they look at it like that. It depends, you know, your style and who you are. The much more sort of technically orientated traders, if they have 200 and it's a high conviction trade, 200's going on the trade. So it depends on your sort of style. So that would be the way that I would try and set that up. So on the point of, should you just trade one contract? No. The point of a sim is to go and experiment with pyramiding. What you don't want to do is learn how to do something trading a 1 lot on a sim and go, yes, I can do it, take it live, but now I'm going to trade 5 lots and I'm going to scale in and I'm going to scale out. It's a completely different skill. So learn all the skills as much as you possibly can on a sim, attempt all of the different things. That's going to massively help you out. I would also, as I've emphasized a couple of times this week, trade different markets. You don't want to sit there going, no, I'm going to trade T-notes and nothing happens in T-notes all day. You learn nothing apart from the fact that nothing happened in T-notes today, and that's it. You know, go and experiment. Because if you've got a technical idea that you're looking at, if you've got a profile idea you want to work on, the principle of the idea will work irrespective of what market it is. The size of movements will vary and the amount of size you can put on a trade will vary, but the principle of the trade is still exactly the same. If you're buying the top of a previous range, it doesn't matter what market you look at, the top of the previous range is the top of the previous range. Your stop's going to differ. So let's say, I'll give you an example of this in a moment with the Bund, but in the Bund at the moment, we've just dropped down. There was a previous range that had a high at 95. We dropped down onto it and we seem to be bouncing back. We're now trading 15. So we're up here. That's the same principle as if that top of range was in oil or in NASDAQ or any of the others. The thing that you have to look at when you're considering where you place your stop, where you place your entry, or not your entry, where you place your exit, is the variance around a level. Bund, I'd be reasonably confident that if this went to 90, I'm wrong, and it's probably going to go further down. If this is oil and it trades 90, I'm pretty comfortable. I'm still okay on this trade. I'm certainly not wrong. Might be uncomfortable, you might not be happy with it being 5 ticks offside, but I think you're struggling to say you're wrong at that point. So the only difference is the sort of variation or variability around a level as opposed to the principle of the trade. That trade is the same, whatever market you look at. So, and that's part of the experimentation, right? Go and work out, are you comfortable with that? Because some people couldn't bear the idea that they buy 95 and 2 seconds later it's trading at 90 and then 88 and look at that and go, I'm fine. I'm not wrong on this at the moment. I don't need to worry about it. Some people couldn't possibly bear that. Other people can't stand the idea that this trade's here, it's Euro stocks, and it goes 95, 94, 95, 94, and 15 minutes later, it's still 95. You're not right, you're not wrong, and you've had nothing that's really told you either way. Some people can't stand that. I'm one of those people. I'd far prefer to see this go like that than I would just see it go sideways and move up, because I feel at least I've got a sense of where I'm right and where I'm wrong. If in something like Euro stocks, you kind of look at it and go, well, I'm right until I'm not, and then you find out whether you are or you're not once it's moved. So that's the big point around go in and experiment, go and test other markets out, and do it more than one.
Doesn't play havoc with your psychology, is it not? It's just...
For me, yeah. For other people, they look and go, well, it's definitely not showing I'm wrong, so I'm fine with that. That you're right until you're proven wrong. So for a lot of people, and the upside of say Euro stocks is, well, if it sits there and does that, you can buy another 50 and another 50 and another 50, and it has no bearing on the market. Like I say, I don't like that kind of feeling. I really don't. I have never liked Euro stocks. I've never liked treasuries or T-notes in particular, because they don't give you any kind of, or any just sort of sense of when are you right or you're wrong. Like if Euro stock sits there and it goes bid 95, offered 95, bid 95, offered 95, if it goes offered 94, are you wrong, or is that just it's happened to take the next price out? Whereas with something like, say, the S&P at the moment, I'll give you an example of this in a minute. If it trades 30 to 27 and it does that, you know that if it trades 26, it's probably going to keep going down. If it trades 31, it's likely to keep going up. But you've got at least that area to go, well, I know where I need to make a decision in this. Whereas with the really thick markets, you're making a decision based on how much trades into the next bid or into the next offer. If you take that to real extremes and go and look at something like ZQZ, which is Fed Fund Futures, and you've got 4,000 bid, 4,000 offered, you're looking at the change in the bids or offers to give yourself a sense of what's going on. You're looking at that, and we have done a total of 1 tick range for the day. I don't expect it to move a great deal today, but it has the potential. Sorry? That's ZQZ, that's ZQX, which is this month, November expiry. So that's got 50,000 lots bid and 10,000 lots offered.
Do you always trade a current month, or do you trade a continuous contract?
Well, a continuous contract is just a chart thing. So what a continuous contract on a chart shows you is the front month, and then when you go back, it shows the previous expired months. With something like Fed Fund Futures, you've got to look at multiple months to understand the difference in where people's perceptions are changing of future rate cuts or hikes. So if you're looking at Fed Fund Futures, I would certainly at the moment have ZQX, Z, H, F, and F, G, and H. So then you can see the broad from basically now until March where people perceive the rate cuts to come from the Fed. You might see quite a distinct difference in price in January, which implies that after December, rates will have been significantly changed from where we are now. So I think look at it like that. We'll get onto that when we get to macro week, so I won't bore you guys with the or not bore you guys, but elaborate too much on the intricacies of Fed Fund futures and what they show you. Sorry? What, Fed Fund futures?
Oh, just in general, just being here.
All right, oh, good. Good. Right, so that's that. And I did just see another question. Do you recommend experimenting with different markets? I'm much more familiar and comfortable with one market. I typically trade NASDAQ. NASDAQ's a mental market, in my opinion, but feel free to trade it. But no, Darius, go and trade other things. You might find that you're more comfortable with S&P. Like if you like NASDAQ, the S&P is going to move very similarly to the NASDAQ, but without the kind of ferocity of movement. You might also, if you like NASDAQ, quite like oil. And so you're then, you've got different strings to your bow. If you really like volatile stuff, go and look at gasoline. That's not a joke. There we go. Or Bitcoin, do something like that. So yeah, vary it around. Also, go and look at treasuries. You might actually like it. Right, delta. When you see high delta, selling side, let's say S&P, you suspect absorption and the movement goes up a little bit and then going down, go up and down, much volume per candle, and or at least can argue that someone has to buy at that price, but you don't know how much they have to. What's the clue that you do thinking now, can the level break, how do you know that? Okay, I think that makes a bit of sense. Let me try and explain at least my perception of what's been said and my interpretation of what you would do. Let's say you've got a level here, let's call that 05. And you see market comes down, and from a delta perspective, it gets here, market doesn't do much, but you see delta and you would see it on a footprint where it's lots of selling. So you've got negative delta, right? Somebody's sitting there with, let's call it, you don't know that they're there perhaps, 2,000 lots on the bid, and people sell 100. Your delta is going down, because it's just market selling. Now, when it does this sort of up and down pattern, somebody's buying there. You don't know when it goes through how much is then going to get sold, because it's a reasonably fair assumption. Somebody buying 2,000 contracts is not panicking about the next 2 ticks. The liquidity in the S&P, for example, would not be sufficient to do this. If you bought 2,000 S&Ps, watched it go down 2 ticks and sold, you would push it down another 4 ticks getting out of your position. So there's no way you're going to be worried about 2 ticks. So it's quite a hard one to then infer how much is now going to get sold if you go through, because you have no idea why that person was buying. For all you know, they're short up here and they're very happy. They're just getting filled. Once they're completely filled, good times. They've took their profit. They have left the building, and you're then wondering what the implication of it is. You ultimately don't know. It's more a case of you've then got to think, what is the next potential step from here? And the 2 ways that I would look at this, you've got somebody bid 2,000. They get filled. There will be people buying above that as well. So people are going to buy, let's say 100 above it, 200 above it. It's less about the 2,000 because this person clearly wants it. That's why they put it there. The people who buy above it though, quite probably are buying because of the large order. If the large order disappears or is filled, well, their reason to buy has disappeared as well. They need to get out. They're the people who are going to come in and sell. They're going to take their stops basically. You can try and work out how many there is, but you don't know where their stop's going to be. Some of these people aren't playing because the large order. Some of them are buying the price above because they wanted to buy the level, but there's a large order there, so they're just paying one wrong tick higher. They're not getting out 1 tick below. Their stop is down here, in which case they're not going to get out. So it's very hard to try and work these types of things out, at least to a point of being convinced of the interpretations you've made. The other thing is you can never verify it. There's absolutely no way that you can know what anybody's true intention was there.
Could you possibly discern that by the open interest in delta at that specific level over, say, a period of half an hour to an hour, as opposed to a smaller time frame? Because obviously,
even over say half an hour, if this period here, if you will, is say half an hour, if they just keep on selling, you're only really discerning that somebody is definitely happy to buy. But what you don't know is for how much longer they are willing to buy, as in whatever they've got to buy, particularly if they're not showing it and they're showing like 100 and then they reload, You don't know how much they've got. They might be able to do this all day long and they've got 20,000 to buy. They might only have 500. So you go, oh, someone's buying, buy. Oh no, they've got. So it's quite hard to work out. The one trade that you can work out, or the one thing you can do, is let's say this is a large order sitting at the level. If you get 3,000 lots bought passively, so minus 3,000 delta at this price, i.e. people have just sat there and got sold to and sold to and sold to, you can, to a degree, assume that some of these people are buying because of this. If this number is bigger than this number, and all these people try and get out, they'll take the entirety of that in one go. You can see this type of thing happening. We used to do it on this would happen sometimes in the FTSE, which is a thinner market. You'd see someone with 100 lot bid, and you'd see people buy 300 above it. When that happens, if it starts to now trade into that 100 lot, you don't wait and you just sell straight into the 100, because you know that there's a lot of people who are long above it. If that 100 starts to disappear, all of those people will sell as well. So you can then have conviction to actually sell into the large order rather than try and front run the large order. I think that might give a sense as to what the answer was for that one, Alex.
Is he talking about a high delta being absorbed, right, on the bid of the assets? Is that a negative?
Yeah, so this would be a negative delta. I don't know if I could find a footprint example that quick and easy.
Appreciate it, Rich. See you next weekend.
Oh, you're off?
Got a job to do.
Oh, wow.
About next week I'm going to change this off the desk and we'll do.
Okie doke.
Right, appreciate
All
it.
right, congratulations. I wasn't expecting that. So I'm just trying to see if I can find a bit of an example of this. I'm not going to spend all day looking for one. If I don't find one quickly, I won't bother. They're not always that common.
Would that be delta exhaustion? You get a high level of negative delta and it stops and it turns around?
Yeah, that could be that, yeah. Well, that can happen.
Yeah.
It's not a great example here, but if you take, say, the S&P here, what you've got, negative delta over all of these bars, right? When it comes down to the low, whilst this is only -6 as an entire bar, at this point here, what you've got is a -47, i.e. 47 more contracts sold than bought. This might be the kind of example that is being suggested here. The way I would interpret stuff like that is I'm not going to try and make a decision based purely off that. This is more about what the next step of the move is. So let's say I like the idea of buying 44. I do actually, 44 is a decent level. Let's say you like the idea of buying 44. With this in mind then, if you fancy buying 44, you could just join this person and go, yeah, I'm good with this. Someone's buying at the level I want to buy. That's what you want. All good. If you want to sell 44 because you think it's going to break the level and go down, what you've got to think about is what the next step is. If someone comes in and they buy it and they buy it and they buy it, once they're out of the way, it should go down quickly. So it's more about what the next step is. Therefore, once this person gets out of the way, you need to be aggressive. You want to go bang, sell it at market, because you're expecting this to move pretty swift. I don't know if we'll find a good example of that. It's not a great example from a footprint, but you've got a fair chunk of volume here. When it comes down to it, there you can see there's not much traded, and then there's not much traded here. So you've got to be willing, as this comes down, to just hit it, basically through the low. So the goal would be to sell it there. And this kind of illustrates it quite well, that if your aim is to sell it through the low, you look at what actually gets sold. 6. That's because there's very little on the bid. So as soon as it gets to the low, everyone on the bid goes ooh, and pulls their bids. So there's only 6 to hit. And then you end up hitting lower and you hit into some more orders. So it's more for me about the implication of the next move as opposed to there actually being anything that you can infer from it. It's just that bit that goes, well, if you like the idea of doing one thing, this is your chance to do it, if you will.
Could that be construed as, that last example, the first example, could that be construed as bag holding?
Bag holding?
Yeah.
No idea.
No.
I've never heard that term before.
No.
So maybe, dependent upon what exactly.
Yeah, well, it's like, what is being absorbed?
Yeah.
Yeah, it's, the prices are held down at all sudden.
Yeah, the thing with something like that, if somebody's going to absorb, the only way it goes up is, well, there's 2 ways it goes up. One, is the person who's absorbing realizes that they're not getting filled anymore, no one's selling, in which case they're now going to have to go and buy higher prices in order to get their business done. If they've got to buy 2,000, they've got filled 500, and now they're getting filled like 2 lot, 5 lot, 7 lot here and there, they're realizing they're not getting them. So it's prudent to then go, okay, let's now go and buy at market and buy 500, 500, 500. Yes, you're going to push the price up, but you get your business done. The other way it moves off the low is the people who are selling down here, thinking it's going to go through this person, realize it's not. And after a while of trying and trying and trying, it doesn't. And now they all run for the exit. It's what I call a scramble. And you get this kind of where it forms this little range. Once it breaks the top of the range, everyone then just runs over each other to try and get out because they're panicking, which helps it off the low. Generally, somebody just sitting there buying is doing it for what I would generally perceive to be a longer term or more what I call structured reason. You're not going to get many short-term traders who just go, I'm buying it here, 2,000 lots bid. It's more going to be someone who they're perhaps buying the 2,000 because they're short from way higher up. They're buying the 2,000 because they're selling 3,000 euro stocks. Yeah, there's loads of different things. They're buying 2,000 because they've got a short position in a number of companies that they're worried some kind of regulatory change over the weekend could screw them over, so they're going to go long S&P to hedge that position. There's loads of different reasons. Generally, they're not doing it because they're trying to take the next 5 ticks out of the market.
Dark pool liquidity.
Possibly. Who knows? But that's the other thing. No one knows. You've just got to look at it and go, well, am I going to try and sell through them or am I going to buy with them? And that ultimately comes down to, do you really want to do anything here? If that's in the middle of nowhere and I want to buy 95 or I want to sell 20 and somebody's buying 05, I don't care. Leave them to it. Because I have no interest in being in long or short at 05. It doesn't matter. Right. On the point of entries and exits, and this is a discussion we were having around before durable goods. So this is looking at the Bund today. Now today's range is starting here. This is a 15-minute and that's a 1-minute. Excuse me. So what you've had is a reasonably steady down move in the Bund so far today. We've dropped, we've bounced, and it's then continued onwards to the downside. The Bund's got a really, really solid level here at 95, which in my view is a really nice buy. When you buy it though, and this is then the bit about your approach to an entry, your targets, importantly, on something like that, and how that affects what you do in the trade. My view on this is 95 is a solid buy, and because it's such a clear level, I'd be quite happy to passive bid that, i.e. put your bid there before it gets there. I don't want to wait and see, because if it is as solid a level as I think it is, it could just go ping and straight off it. In which case, if you wait to see what happens, well, what happens is it's trading 98 and now you're not in and making a decision from there. So I'd look at that and say, well, 95, I'm happy with that. You've got this little high here, which is 89. That's a potential place that you could buy. So if you want to scale in, you could treat this as a little zone and say, well, I'm happy to buy 95 to 89 with a stop below 89, probably just below yesterday's low. So we'll call that 87. So now you've got an idea of what your trade is. The other aspect of a trade like this is your decision about what you're going to do with it. Right? What is your target on this trade? Because one of the things that I think people often make a mistake with is they go, yep, 95, good level, I'm buying that. That's great. What are you buying it for? Are you buying it for a new high? Are you buying it for a quick bounce? Are you buying it for a back to the middle of the range? So those are the questions you've got to ask yourself to decide what exactly are you going to do now you're long. So you've got a few choices here. And the first of which is, well, that was the low earlier on in the day at 05, target 05. This is what I would call a quick scalp type trade. It's a reaction trade. Trade's 95, you get out at 05, job is done. You're expecting that to happen reasonably quickly. You could get that in 2 or 3 minutes. In fact, you do actually in 2 minutes. You get the 95s. Nice trade. There's a different variation of the trade, which says, well, actually, if you get back above 05, why not go back towards where we've just come back down to through this range, and your other target is 21. That's another variation of the trade. which is going to take you back up here. That's perfectly fine. And your other target is then, well, and we'll get onto this next week, that is a really bad high. So your other target is 50. So you've got 3 potential targets on this trade. You have got 30 as well, because that's this little breakdown here. So you've got targets at 05, 21, 30, and 50. Now, you could pick any one of those. And I don't think there's a right or a wrong target. You've then got to weigh up the probabilities of reaching any of them. 05 should be pretty easy to reach. If it can't reach 05, you're just wrong. This trade's not going to work. So 05 is a pretty binary scenario. 95, 05, job done. 21 I think is quite reasonable. Don't know if it's quite traded 21, but it's traded very close to 21. That seems reasonable. That would be my kind of line between these now require quite a significant change. It's got to get above 21, so it's got to get through this area. Then you're going to get to 30, which is reasonable potential. And then you're going to go and break the high. Now my issue with breaking the high is the energy in the market today. If anyone's been watching the Bund, it is, in my view, just too slow to do it. So I don't fancy that. I think the probability of going there is probably less than 5% chance. Probability of 30s, I don't think it's a terrible chance, but I think you're probably on more like a 30%. These are the two that have got a high probability of actually getting reached. And part of this, these percentages don't view this as, well, that means there's now 65% left, because that would then imply that one of these will be no better than that, which is not the case. The percentages, if you will, is my view on the likelihood of this happening. So view it as almost odds on something rather than a totality of percentage. So in a way, I'm going to look at that and go, do you know what? I don't think it's worth going for these. It's a little bit too low probability, and there's too many things that have got to happen for this to work. In terms of where your decision making needs to be though, you've got to decide when you enter the trade what you're going to go for. Because the worst thing that can happen is you say, I'm going 05, and it does what it's done today. It trades 05, it ticks above 05, and it trades into the mid-teens. Now you're stuck, because now you're out. Do you really want to buy in the middle of the range? Probably not. Because if you buy in the middle of the range, your stop's now got to be back below 05, and your target's only 21. So you've got very little payout on that trade. It's not worth it. So if you go into 05, you need to have an acceptance that you could miss the rest of the move. This is a scalp. That's it. If you go into 21, your acceptance has to be that it could do this, and you're going to get stopped out at 87. Not great, but until it gets above 05, and I mean trades above 05, sits above 05, you're not right on this trade. You're in the no man's land of uncertainty between 95 and 05. It's either going to go up or it's going to roll away from there, and you don't know which. So that's kind of the way that you need to sort of go through that decision-making process. Key with any kind of entry and exit strategy is you want to, before you take the trade, decide what you're trying to achieve with it. Otherwise, you get stuck in this kind of uncertainty zone at 05. It gets there, and you go, oh, what should I do? Today, you might have got away with that. Your uncertainty would have paid off, or your hesitation, because it got through 05 quite quick. And by the time you've gone, oh, I don't know what to do, it's trading 9s, at which point you go, well, okay, I'll put my stop at 02 and leave it and see what happens. Other days, it will trade 05, come all the way back to 95, and if you didn't have a plan, now you don't know whether to, you shouldn't get out, but you don't know what to do next. The other thing to talk about is scaling. I don't think it would be unreasonable if you said, right, my stop's 87, to buy 95, 93, because that was the low before we broke out yesterday, 90, I think it's quite reasonable as well, yesterday's open, and then put your stop at 87. If you're doing that, yes, you're going to take a bigger loss on it, but you're also getting better prices, and you could then scale that out, and you go, right, 95, 93, 90, get out 05, 21, 30. You might not get the 30, but if it goes 21 and struggles, you get back to 21. So it depends on what you're trying to achieve on the trade, and that dictates the sort of tolerance for risk on a trade, and it dictates what you're going to do at certain points along the way. You need those decisions to a degree made before you enter. Otherwise, you're going to end up sort of ad hoc making decisions.
Sorry. The question is this. What risk parameters do you have to see as well? Depending on the size of the
It's discretionary. No one has a percentage, really. Yes. So for most people, on a day, so rather than on a trade, because you're not going to make a decision on someone's trade, that's their trade. On a day, everyone has got a stop on a day, which is more to do with their capacity to make money than it is to do with a percentage. So if somebody can regularly make 10 grand in a day, they can have a 10 grand stop, because you know they could comfortably make that back tomorrow. Someone who doesn't make 10 grand in a day is not going to have a 10 grand stop. It's relative to more to do your performance. You know, some people may only ever make, say, 1 or 2% of their account on a day, so therefore their stop is actually percentage-wise quite small. Others have much more variability or much more sort of range of performance. They may have a percentage bigger stop, but it's a lot of the sort of risk management comes down to the way people trade. You know, somebody who's got huge capacity to pull off a very large day will also be allowed a very large stop. Somebody who doesn't have that, it's going to be smaller. Likewise, some people will have a large stop despite the fact they would almost never go anywhere near it, on the basis that they're only ever going to take that level of risk in very niche circumstances. So it's very individual. In terms of an individual trade, the key thing to any stop is at what point are you wrong rather than anything else. You can't do it from the perspective or from the way of a number of ticks. You can do it for an amount of money, but you still can't change the number of ticks stopped to make the amount of money different, which is another reason to not trade a one lot. So let's say you're looking at this. If I'm saying 87, I'm wrong. And the reason I say 87 is I need to get through the support, I need to get through the next support, and then I don't believe it's bouncing back. It might, but it's not bouncing back in my time horizon or in my understanding of what this trade is. You know, my assumption here is it can do that and it's okay. If it goes here, it might then do that, at which point, yeah, I prefer to be at 87 than getting out at 68. So make it a point where you're wrong. The other thing being, from a monetary perspective, you can look at that and go, well, okay, I'm taking an 8-tick stop. Oops. 8-tick stop, that's 80 euros. How much are you willing to lose on this trade? Which is not a standardized thing. So rather than go, well, I'm willing to lose 400 euros, so 5 lots, you've got to look at it and go, is this the best trade of the day? If you think this is the best trade that you're going to get all day, this might be worth 800 euros of risk, because you don't think you're going to get a better opportunity than this based on your perception of how likely the level is to work and your expectation of payout. You know, if you're looking at going back to 20, you're on a 25-tick winner, an 8-tick stop. If you think this is the best trade of the day, you might go, you know, I'll risk 800 euros on this. If it works, you're getting paid 2,500. Yeah, so that's your overnight gap. But yeah, really from my perspective, the stop is just purely, I've broken one level, I've broken another. You're getting to a point where, well, how many more levels do you want to break before you realise you're wrong? So that's why I put in 87 on that one. But yeah, quite a nice example today in the bin. You had similar, you could have flipped this over and said, well, it's selling 21 earlier, looks like a pretty decent trade, particularly from a profile perspective, which we'll touch on next week. But basically, big area of low volume, single prints. Your stop would then be at 32 and your target's a new low on the day. So you could have then had the same, basically 25-tick winner to the downside. Technically, the bun's been perfect today. If I was to sort of go, right, here's a perfect day for technical trading. There's an initial balance there. You sell the break of the initial balance. You had a target at 14 and I got a level at 06 from 2 days ago. You then sell the pullback to the single prints at 21. You take it down to the next previous level at 95 and you reverse that back up. Job done. It's one of these days where if you're somebody who's just very rigidly technical, you would have got every trade right today and all of them would have paid you 15 ticks plus. Would have been a lovely day. Right, before I show you the S&P one, which is the one I was going to talk about, sort of thought process within a trade, I'll just mention trading task for next week. So what I try to do with the, if you see on the calendar, there's the sim trading parts at the end of each day, mornings, etc. Trade whenever you want, but one thing to go and have a go at for next week, which makes you think about where you're entering, where you're exiting, kind of position, whether you're right or wrong on a trade, or whether the move is ended, more to the point. Because one of the easy things to do, let's say that Bund one, you buy 95s, you could give that up at 05. The question then is, well, has this move actually ended yet or not? So the idea of this is what I call a cut and reverse exercise. The goal is, if you're going to get out, i.e. sell, to exit a position, what's that do? If you're going to do that, you have to go the other way. So it's a little bit of a challenge for you. It makes you really think about whether your view of what's going on technically is right or it's wrong. Obviously, it's not a viable approach to trading because, of course, there's three things you can do. You can be long, you can be short, you can be nothing. So it wouldn't be an approach to trading, but it's an approach that makes you really think about what's actually going on rather than do you want the profit. So it gets people away from this focus on profit when you're on a sim. You can also, and this is then a sort of advanced version, increase your size. So if you start with a 2 lot, you could increase your 2 lot to 4, get out of 2 and stay long. So take those 95s in the Bund, you buy 4 lots, sell 2 at 05. Then when you get to 20 and you want to get out, you've got to then sell 4 to go short and play it like that. So increasing size on the trade is beneficial to allowing you to manage the whole idea of the move rather than needing to sort of flip. The more frequently you flip the trade over, chances are the easier it's going to be to get out of sync of what's going on. That's the hard bit. If you get out of sync of a move, you're then very quickly in trouble. Yeah, if you say took that Bund one and you bought 95, then went short 05, it ticks down to 02, but then goes to 06, you then go back long and say take a loss. It might have then gone up and back to 02, you then go back short, then it goes back up and you go back long, and before you know it, you've lost. You're better off, and it makes you really think about, has anything actually changed, or do I just not like this? Or are you over-interpreting small changes rather than going, well, till it gets here, I'm still good.
So essentially, you could even have a trade every 30 seconds or less.
If you really want to, yeah. If you're super indecisive or you're an absolute genius scalper, you could, yeah. If you can do it.
It's going to play with your head, isn't it?
Yeah. So I would generally try and look at it, don't just get out of trades. Try and stay in and appreciate the sort of ebb and flow of a move, because they're the bits that get people out of trades a lot of the time when they shouldn't be. It's just, it's not going to go in a straight line. And so if it's going to do this, oops, I can't draw on a PDF. If it's going to do that, no way are you wrong. But if you keep trying to change your mind, you'll end up long, short, and it becomes messy.
So let's say I'm long, I decide that I want to get out. In order to get out though, I'm also going to have to define what my next target and stop would be.
To a degree, or you've just got to go the other way.
And
so then you've got to think about, well, do I really want to go the other way?
Yeah, so you actually,
because my stop may now be miles away, because actually that's where you're wrong, in which case you probably shouldn't have gone the other way.
Yeah.
So
I suppose it depends on what time frame you're thinking. Right, generally, we used to think in half-hour increments and then down to 9 minutes, but not to 1, and then early, and then 4 early, but 4 early, further out. But so half an hour, 1 hour, 9 minutes, or 5 minutes.
Yeah, well, yeah, you can do it on whatever time to a scale that you want. The shorter the time frame that you're looking at things, the more frequently you're going to change the trade over, which then makes you kind of appreciate, has anything really changed, or are you just changing your idea because of X, Y, Z?
There's an interesting book called Thinking Fast and Thinking Slow.
Yes, it's fantastic.
Yeah, Dan Kingdom, so yeah, bit like that.
Yes, exactly. Right, I will leave you guys to have a go at that. I will post it in the group as well. So I'll just have a very quick look at the S&P. We talked about it earlier, Peter. The S&P's it's off to the races.
It is.
Which
NASDAQ.
Yeah, which a lot of it all comes down to. I put this one up earlier to try and explain a bit of thought process and what I think. So you can kind of go from here on what's going on now. Actually, I'll put up the one because you've got the next day. So I'll bring up the S&P chart. Here we go. So this is a good example of that from the point of view of sort of the if you're playing the cut and reverse idea, at what point should you actually change your mind? From an hourly perspective, we were talking about this morning. What the S&P's done is sat up here for a couple of weeks. Day before yesterday, you got this really fast straight line drop, what I'd call a liquidation move, which fails to stay below 44. And that to me was the real key bit of information. Yesterday, we bounced back towards 68, which is another important level for me. It was the high of the first breakout, the high of the pullbacks before another leg up. We come back to it. Don't break it, go down again. Yesterday though, it failed to reach the low, which my view on that is this is really bad news for sellers. If you're a seller, you've got to at least get it to the low the next day to prove that there is enough selling in this. They fail and back up it goes. So essentially my view on today is exactly the same as it was yesterday. If you stay above 44, this has got the chance to go up. And if you get above 68, it is definitely going up. The question then is how far? I don't think there's much for me, any question about will it go up today? Well, it's going up now anyway. But once it was above 69, it was a question of how far it would go, not will it. So that then, if you were doing the cut and reverse exercise for me, is just a straightforward case of you buy it and you sit on it. You don't need to cut and reverse that. If you want to get detailed, you could perhaps then try and take some bits out of it, sell, get back in, sell, get back in, sell, get back in. But you've got to get that right every time. The better way to do it, like I say, is do it on micros, go and buy 6, buy another 6, get out of 6, buy them back, get out of 6, buy them back, get out of 6, buy them back. Then you're keeping the original 6. It'll move your average price around, but just remember where your original position is. That's the other key to pyramiding. If you're going to pyramid, let's say you buy 70, and then you buy, as it starts to move, 73. If you've done that, think about it as this is your kind of core position, and then this is an add. When you get out of this, your position is still 70 in your head. It won't show it as still 70 because it fills orders, or Jigsaw shows orders as filled FIFO, as it's called, first in, first out. So let's say you get up to 80 and you sell, and you sell 80. So now I would, in my head, think, well, I've got a 7-tick winner on that, and I'm still long from 70. The way Jigsaw will show it is you've got a 10-tick winner and you're now long at 73, which is really annoying because I'm not in my head. It doesn't matter how you add the numbers up, you're still going to get to the same number. You've got a 10-tick winner and your 7 ticks on side, or you've got a 7-tick winner and your 10 ticks on side. Doesn't matter which way you do it. But I try and sort of keep a mental note of what my core position is, the original position that I believe is going up. And you could then say, well, my target's 93.
Is that because it averages it?
Yes, the way it would show it on, say, Jigsaw, if you buy 70, then 73, it would show your average price 71.5, which is fair. I think it should. The thing that it does is when you exit, it then takes that original one away, so then moves your average price up to 73.
Right.
I hate that. My view is your average price is the average of all the contracts you bought. So if you buy 70, 73, try and do the maths on it, and 76, your average price should be 73. And if you sell 80, your average price should still be 73, despite the fact that, depending upon how you do the maths, it's now halfway between, it's now 74.5, or if you perceive you've sold 76s, the one you bought at 76 is now 71.5. So your average price is reasonably irrelevant. It's something to think about for yourself. You should, if you're pyramiding on a trade, know the prices you bought. You shouldn't go, oh, well, my average price is here. Yeah. You should know I bought 70, 73 and 76. And if you don't know that, you've got to question why you bought some of them, because you should have a solid reason for buying at any of those points. Where you are now then for the S&P, it's just traded 90.
Let's go back. The failure, yes, it 4785, 89. You consider that test into a known area of previous volume as a second or first or second test?
This one?
No, the second one.
This one?
Yeah. With buying tails.
I would view that as, basically it's traded down into this area again, and it's just failed to find enough sellers.
Conviction on your trade.
Massively. Yeah. As soon as you're above 44 today, my view is it's going up. Yeah. It's going up until 69, at which point, if it is going to fail, if it's going to go down, it needs to fall from here. If it doesn't fall from 69, it's going record highs. I don't mean it'll go record highs today because of the current range is in the S&P. I don't think it's got enough in it to get there. That said,
You've got news out
60 handles?
Well, you've got United States Michigan consumer sentiment. How much effect would that have on the S&P?
not enough to get through record highs.
Yeah.
The way I would look at that today, if you're in a market that is very clearly moving towards the upside,
Would that be a reason for taking profit on that news and then
No.
flush out lows and progress? Or?
I would look at it the other way. I would view this as, whoops. If you want to be long S&P today, and you're not in a position, let's say, it's just trade 92 and 3/4, so I think that's a pretty fair place to have taken some profit. If you want to be long, I would look at Michigan and look at it as a straightforward, Michigan's a buy, whatever the result.
Really?
Yeah,
Good or bad?
doesn't matter.
Doesn't. So that,
The idea being, if it's good, you buy the high and play for the continuation. If it's bad, you buy the pullback to 81 or somewhere down there. So I kind of look at it as like, the market's already decided what it wants to do.
Yeah.
This number's got to be catastrophically bad to change people's perception of what's going on just on one piece of information, which is a sentiment data point as well. That's my interpretation of that. It's going up.
so it's not the fact that good news is bad news and bad news is good news.
No, it's just the fact of what the market currently suggests it wants to do. Yeah, you take the last 2 days, it's got some longs out, that's the liquidation.
Yeah.
It tries to go down and fails. It's now going up. Everyone who was long here and got stopped out here now needs to get themselves back in. Is Michigan going to change your view? If you really want to get back in the S&P, how much is a survey of phoning some people in the middle of the day going, what do you think inflation is going to be in 5 years' time, going to change of your perception of the S&P today? I don't think much. I think it's a buy. Just to confirm that's not advice before everyone goes piling into futures and they go, Rich told me to buy and it didn't work and now we're going to sue him.
Oh, you're not giving investment advice, are you?
Precisely, it's not investment advice. Indeed. Thank you, Peter. Yeah, it's my opinion that is the case. It is not my advice to do anything with that opinion. That is your choice. Right, okay. So I'll try and talk you through sort of the thought process behind where I want to take a trade, why I want to take it, and what the approach is. So this was on yesterday's one. The reason for doing this is I actually sat down with somebody yesterday and talked through what I would want to do at certain points. So I would try and replicate the way that I approach this, at least on the trade side of things. I'd always start from a sort of higher time frame. So from an hourly, the way I'm trying to look at this is yesterday, as I say, liquidation, bounce back. As long as it's above 44, in my head yesterday, this is a buy. So I'd have a broad plan. This doesn't mean these are absolute nailed on entry points, but my broad plan is it's a buy at 44, it's a buy on a break of 69. That was my kind of general type of plan. As I put there, I would more be inclined to look for a continuation pattern above 68, 69, i.e. get up here and then give me a flag or something to play the move up from, rather than just buy the break.
And the rationale for that is?
I wanted to prove to me that it's not just going to test the level and roll over, because it could just still sit in this range. It's not a breakout where I feel there's anybody who's vulnerable to getting stopped out, so therefore there's not a reason for it to rush higher. It's got to get over there, and then you've got to find people who really do want to buy it to keep that move going. On the downside, if you're convinced of this being a good reversal, then I think you can just be more passive and say, right, well, I'm fine buying 44. I've got these little lows here. I'll illustrate that on a shorter time frame in a minute. 44 to 38. If it falls into that area, you can just buy that on the basis that it shouldn't go down. And as long as it doesn't, you're all good with a stop at 35 to play for initially 68. So basically play it back up the range, and then possibly you get the breakout as well. It's very similar to the Bund by 95s trade today. So that was kind of the broad sort of play, if you will. And then you've got to then bring it down to, well, how am I actually going to execute this rather than bid, stop entry buy at the top and leave it. So the only danger I think you've got, more to the point, the only chance you've got to sell is it's got to get through 44, 38, 35. If it gets through 35, I think you can change your mind, and then you can have a go at selling it, ultimately to go and test the previous day's low, or at least the bottom of this little range. So you've then got targets on the downside of 15 and 00. Personally, I wouldn't try and sell before 35. If your view is it's still going down, because everyone's got a different opinion. If broadly your view is I think the S&P is going down, then fine, sell it from here, sell it on the break of 44 and play it for the downside to start with. There's nothing wrong with doing that. That's just not my view of what was going to happen yesterday, in which case I'm never going to sell it before 35 because I don't believe it'll do it. Obviously I was wrong and it did it.
Just one interjection question if I may. If you're saying about not going to sell it until it gets below 35, what was the lowest price yesterday?
The lowest price yesterday was 25.
Okay,
No, sorry, that was the day before. The lowest price yesterday turned out to be 23, 22 and a half.
Okay. So you would have sold it with price confirmation, with the break below 35.
Yeah.
You would have, okay.
Yeah, I'd aim to sell the break of 35 with the view that it's going at least to 15. So then it gives you a tricky situation of when it never makes it, what do you do with it? And so from there though, the initial idea of buying 44 to 38 starts to lose its value. The reason being, and we'll go into profile next week, is put in a very small initial balance. So a small initial balance generally suggests that once it breaks, you should get directional movement. Seeing as the small initial balance has a low at 42 and a high at 57, I don't massively want to buy 42 because if it tips through 42, that could bring in people to come and sell. So if you're already in, I think you stick with the trade. Yeah, if your view was straight off, I'm buying for 44, I don't think you should get out. But you should be aware that you're much more vulnerable now than you were before because you've concentrated everyone in a small area.
What would you consider a small initial balance?
You look at it compared to previous days, I would say anything in the teens or lower would be small nowadays. You go back 10 years, anything under 5, anything over 5 big ticks would be considered reasonably big. Yeah, we're into a whole new world of movement on the S&P. It's amazing. Yeah, that was a whole day's range when I started for the S&P, and that was that. So you do then vary what your approach here. I would be a little bit more inclined, if I still want to buy it, which let's face it, is above 38, so yes, I'd be happy to buy a break and pull back and play it like that. So get back above 42 and play the long then, because it's shown me the stop, it's shown me a failure down. So that would be the one way of them buying it. Or as a buy, you buy 57 on the break and play for the 69s. If it goes down, if it just goes 44, 42, 38, 35, I would then be quite happy to just sell 35 because you've actually got that show of direction. So what you end up with was this, which means you are probably, and this is an almost guaranteed loss for me on a trade like this. There's no point in going, oh yeah, I do it all like this, I get this nailed on, it'll all work. There's your initial balance low. It breaks out, it doesn't reach 38, it goes back in. That to me is a buy all day long. You're buying 42, you know where your stop is. But yes, you could say, well, you could have bought 42 ages ago. Yes, but now I've got information that it's tried to go down and failed. In my view, this should now go to the other side.
And there, are you looking to buy again once it breaks 42? So you're taking liquidity from the market as opposed to passively sitting there within the, because I can't possibly be sitting there trying to on the bid underneath that level.
Yeah, exactly. You're sort of going with the people are now starting to buy. You start to buy. So yeah, you're effectively taking some of that selling liquidity away. But it doesn't do it. And this is where this trade gets ugly. You don't want to get out at 42 on a pullback because this still could be the only flick through the IB that you get, and it could still go up, and you could still do that. So you don't want to get out. You're in the trade now with the view that 35 is still your stop. What I would say on this though now is I'd be very strict on my stop. At other times you can give it a little bit more leeway. You kind of go, well, 35, but if it flicks 34, I'm happy and I'll let it come back and see if it's going to bounce. With this now, I would look at 35 with the view that if it trades 35, you need to get out of this because it could then just drive towards the downside. There's enough chances that people have had to buy down there. If it goes, there's lots and lots of people now who are probably long who are hoping it goes up, so they could all run for the exits. So this then gets to the point of the actual in-trade execution, which I'll bring the ladder up in a moment. If you're playing it short, so let's forget that you're long or you never got long. If you were playing the short here, first thing, if it breaks that level, I'd expect it to drop quick. So your entry strategy has to be at market. You can't wait. If you wait, it's gone. Once you're in, then it's a case of you need to have also made a decision as you get in on that break, one, where your stop is, and two, what you're trying to achieve. My view on it was the target was 15, and the reason for 15 is that was the point, and I think we talked about this yesterday, the delta reversal point where it went back up from. So that was the point that it turned back up the previous day. So that's why I was looking at 15. You've got a level at 25. If you want to find a reason to get out, you've got a reason if you're looking for one, but my view is 15 is the place to go. So I'll try and talk you through then what the kind of mindset is around how you trade this. And also part of the execution, because the way you execute a trade is going to affect the way that you manage the trade. So let me get this one up. Right. I may speed this up at times, so I think it's probably about half an hour for all of it. Right, okay. Why is that not starting?
Is there any specific criteria for a delta reversal at a specific point? Do you think perhaps we a low volume load or?
No, delta reverse is just purely a case of you're going down. This one's a good example of it. You're on the way down. This low is formed and delta's there. This low is formed and delta's higher. So that would be my reason as well to think if you get above this line, that's your chance to play back up. It's very similar to the previous day's trade.
What time period is that then?
This is a 1 minute chart.
1 minute chart.
Yeah, it's the best way to kind of illustrate the real short-term movements. But yeah, I would look at that from the point of view. And the way I kind of interpret something like this is, this has broken the low here. It should go now. If your target's 15 or 00, it shouldn't be coming back above here. A trending market will stay below previous lows. If it comes back above, I don't like the look of it. So I'd want to be out of that one. If you like the idea of this being a buy the dip type trade, then when it gets back above this low, you could try and buy that and try and play that one back towards the upside. So what you've got here then is we're trading around 37, which is roughly around here somewhere. And this is then the approach towards the lows. As I said, I'd want my stop at 35. Or if I'm trying to sell, I want to be very quick to get in. I don't want to be kind of waiting around on this one. I don't think that you should get the chance to play a pullback on this. If it's going to work, it should go ping and put you on side. So at this point, it's trickling down. There's not enough in that to make me want to sell. You know, if the real level's 38, I'm fine with that. We've gone 36 and a half, 35, 36 and a quarter. Again, there's not enough in this to make you want to sell, I don't think. What I'm looking for if I want to sell is a bit of a rush towards the downside. You know, a bit of a sort of show of some pace, and you're not really getting that at this point in time. That's a bit better. And then what you start to see is somebody starts to reload here. So that, if you want the short, is your place to then have a go at a short. It's traded the 35 as well. So if you're short this, your view is it's on its way now. We've achieved what we want. Your stop's going to go 39, and you're looking for more downside. And you see there, it's done that extra volume here. That's another good reason you could try and sell that.
Was that an iceberg?
Yeah, and it did again at 31 3/4 as well. So you could sell that as well.
No icebergs. This is the thing with the ladder, but I'm on top of that. We'll talk next week.
Well, yeah, not all of them are going to work, but they're playing into the idea of a move down. You're expecting people to come in and sell this here. So if people come in and sell it, you trust them because it supports the trade that you're looking to do. It doesn't mean that they're going to get it right, and it doesn't mean it has to go. But what you can tell is, well, people have definitely tried to sell 33 and a quarter. They've tried to sell 31 and a half. It's now pushing on and on and on as well. This is all good news. Where you have to make a decision at this point now is, what are you going to do with this position? If your play is it's going 15, then I think you have to look at it and say, well, until it's back above 39, I can't get out of this. I'm playing for 15. I'm 6 ticks on side, not even 6 ticks on side. I can't get out. My stop's up here. Leave it. Let the trade do its thing. It's a decent payout if it works. Yes, it's a bit costly if it doesn't, but it's a good trade.
Would you not be tempted to take something off the table?
Why?
Well,
You believe it's going to, as you were saying earlier, right? You believe it's going to target.
You're-
Try to hold it to a target.
That's my view. I think, yeah, if you think it's going to 15, you're not even halfway there. I don't want to reduce what I'm going to get paid on the trade. It depends on how short term and how much you want to micromanage the trade. You could look at this, and this was the bit of the trade I was talking about yesterday, was if you were slow to this, to getting in, then what you're looking for is the market to establish small ranges. So this is now your kind of in-trade thinking. It starts to establish range. You see there, every time it goes down to sort of 27.5, it struggles. It's done lots of volume down here, and you see we're starting to build volume up. So the fact that it's doing that is showing it's happy to trade down here. And when I say it's happy to trade there are quite a lot of buyers and there are quite a lot of sellers, hence the larger amount of volume. So it's now effectively stuck in a range. If you're really short term, so if you're treating this as a scalp, you've sold the breakout and you're going for the next leg. Now that you've got here, my view is this is now a market that basically has a high at 30.25 or 30.5, and it's got a low at 27.5. Until it breaks either of these, I'm expecting that. And either it's going to break and go up, or it's going to break and go down. And until it does either of those, you don't know which it is. As I say, if you're playing this as a quick scalp and you're expecting this to be a really quick move, then I think there is some viability in going, well, it's getting stuck. I can get out at 28. I will also have a stop at 31, 32, and that's my trade. It's going to have to take 38s and zip lower, and then I would also look to try and get back in. So on the idea of scaling out, the fact that it's now ranged here, you could look at that and go, well, I can scale out 28 as long as you're willing to sell the break of 27. So if you can buy 28s back, but you've got to be willing to sell 26.5 if it goes again, so that you're not reducing your size too much. That'd be the first bit. So the fact that it's doing this, I would be quite happy to just sort of sit there, particularly if I'm looking for the big move. If I'm looking for the big move, like I say, my stop's still got to be at least above 35, probably still 39. And so this is then the waiting game part of it. This is the hard bit. This is the bit where you can talk yourself out of a trade. The fact that it's dropped so quick, this move here, one of the main things you have to think at this point is it needs to take a break. You know, think of it like running a long distance. You're not going to be able to just keep on running the same pace. You need a break. It takes a break to essentially, for the next leg to happen, you need to find new sellers who are willing to push this down. If you don't, the people who did sell it are then starting to get a little bit touchy. You know, you imagine you've sold it yourself, you're starting to get a bit nervous now. They're the people who, if it breaks above 31, will then scramble to the exit, and they're all going to run for the exits. So for a really short-term perspective, if it starts ticking up here, you've then got this quick move up, and this is the bit about how do you manage the trade, right? You could try and exit at 31 on the basis that this will probably rush up if it goes through there, in which case, if you want to try and bank it and then sell higher, you can do that. The downside of that approach is if it trades 31, 33 and down, you will not back in the trade and you miss the big move. The upside is you bank something and you get in, as this one happened to be, really nice back at 38, which is the other way to do it. So you have to constantly be making that decision for yourself on what you're trying to do. It also depends upon, you see it starting to tick up now already. So if you really don't like this and you're sort of trying to do it short term, you'd be out of it. You see it move the average price. I wouldn't want that one.
Can I ask you a personal question? When you're in a trade like that, do you use visualization of how it, when the trade is happening, do you use visualization before it happens to try and counteract any other scenarios that may happen?
Yeah, in a
I'm not
sense.
saying wishful thinking, I'm saying, you know, this is A, B, C.
In a sense, yeah. What I'm looking for is, like I was saying, if it's going to go down, my expectation is it will go quick through the level. So as long as it does that, my view is this is exactly what I thought it was going to be. Good, I'm happy to sell that. So there is an element of visualization of how it should do it. If this had just done the same as it did here and crept down, I wouldn't be confident to sell that, and I'd be quite happy to go, yeah, I don't know, I'm going to leave this one alone. Once it's done this then, let's say you've got out of the trade. The next bit is the entry up here. This is where I think you can scale your position in, because the break came here, which is 36.5, I think it was. So you could sell 36.5, say, well, it might just touch the break point and that's it, and it will go down. So you can get your offer in there. You've also got this low here, which is 39.5. So your stop is still got to be up above 39. You've got this little low at 39.5. I'd got a previous level at 38, which was the previous day's VPOC from a profile. So this would be one I'd be quite happy to scale in, and you could do this passively and just go, right, I'm perfectly happy with 38. I sell 36.5, 38. We're all good on this. And that would be the way that I try and take that trade on. When I was talking this one through yesterday, I end up missing this and selling it at the top of that range. So you're then effectively taking the loss at 32. This is why your entry point matters. Because if you sold 38 or 36.5 originally, this is just back at a scratch. You'd be quite happy with that. If you chase the market down and you end up selling 31, 30.5, it's a much harder trade to hold back. And you kind of then have to take your loss at 32s. And then you've got to go, okay, well, I lost there, but I'm still going to resell it. So there's a sort of psychological aspect that if you screw the first entry up, you've still got to have the mentality to say, yeah, but this is still a sell. I'm still happy with that. Don't panic yourself out of it. We're all good now. We're back up at 38, 39. As long as it's not trading up through this low, 39.5, we're still good. And as long as it doesn't do that, you're okay on the trade. But because this is a passive entry, this is your pullback to the level trade, this has less of a sort of time critical element to it. It can sit here for 5 minutes, 10 minutes, and you're not wrong. You're wrong when it trades here. And if it doesn't do that, you have to sit there and go, this is fine, just let it do its thing. Wait for it to move. Like it did down here, it establishes a small range. As it happens, your small range is basically 36.5 to 39, which is not nice because your original entry was 36.5. So it's basically just ranging above you. Again, it doesn't mean you're wrong, but because you're trying to scale in, you have to sell the low of the range. Otherwise, if it doesn't, if it doesn't get into the range at all, then you miss the trade completely. So you have to kind of go, well, I'll sell 36.5, I'll sell 38. You maybe sell 39.5 as well. If you want to go for my last chance to sell, you could front run that large order and try and sell that there.
I just, for example, say you took a 2-week trade there on the way down, the way up.
Yeah.
At any point, would you walk away from your desk to gather your thoughts again and then look for the next trade? Overconfident to trade again?
Personally, in this situation, no, because technically it's right where I think it should be. So if I've sold this and then played that back up, I'd be quite happy to say, well, it's right where I would have wanted to sell anyway. There's no reason not to. The other part of that is if you've just taken, let's call it a 6-tick winner down and a 6-tick winner back, you're 12 ticks up. You've got some risk now. If anything, do this one with more size and risk it, because the wider trade that you're really looking for is 38s to 15. This is the best chance you're going to get to do that trade now. And this would then be the point where I'm now from an in the trade moment, I'm comfortable with my stop, I know where my stop is. Now what I'm thinking about is, what's it got to do on the way back down? And the key thing this needs to do on the way back down is this range again. Get back in there. If it gets back in there, now it can go. If it doesn't get back in there, you're in trouble. So the most important level now on the way down, and this is something you're never going to be able to plan before, is 30.25, 30.5.
At any point during your training career, when you've been on side,
Yeah.
have you ever had to rein yourself back in because you've been overconfident?
I couldn't name a specific moment, but yeah, definitely.
Yeah.
There would definitely be trades where you're in and you're like, yes, this is going to be amazing. And you need to sort of go, wait a minute. I think that happens to most people at least once a week, where you're in a trade, it's on side, and in your head you're like, this is the one. It's going to go, and it doesn't. That's where you have to sort of lean back on your technicals. It's where you also have to lean back on, like I said here, this whole point of don't get too carried away with this at the moment. You've got a nice entry point. It's all good. You've got a clearly defined stop. Your stop is $300. That's pretty acceptable. If this runs to target, you're taking $2,000, maybe a little bit more, depending upon precisely where it gets to and where you are precisely in. It'd be 2,200 in this instance. So risk reward's good. Positionally, you're in a nice place, but you have to keep in the back of your mind, or you have to keep in your kind of process of what needs to happen next. That matters. And if it doesn't break that level, and if it gets stuck there, you have to be willing to accept that you may have to give this up at 32 again, and it's not going to go. Or, and this is the other bit, whenever you're entering a trade, or you say to yourself, if this doesn't go through the lows, I'm happy to just get stopped out. I'm not going to fiddle with it. And that's something that you have to make a decision yourself. If you fiddle with it and get out at 30 and a quarter, and it just goes quarters, 29, 28, 27, 26, now you're out and you missed it. So you've got to weigh up, are you willing to make any decision here, which might be to your detriment if it runs, and it will be to your benefit if it bounces, or are you just going to go, the trade is this, sell 38, aim at 15, job done, leave it alone. And in which case, if you're doing that, put an OCO in and then go for a walk.
That's right.
Go and give yourself a break.
Essential for your internal dialogue to be consistent.
Hmm.
Yeah.
Which is why I always say you've got to always come back at least to some degree to your original idea. And if your original idea is, if it gets below here, it's going down, well, it's below there, it's going down. So then you have to then pull that down onto a shorter time frame and go, well, does this still stack up with my idea? Is it still going down? Yes, it is. It's all looking good. It's also broken out now of the kind of mini range that it formed here, the sort of 36 to 39. So whilst it's now below there, if you really, really want to get in some more, I don't think this is a wonderful place to do so. But if you imagine that as your little range, 36, 39, you could offer 36 now, which was your original entry on the pullback. But now you've got more information. You sold 36 and a half, sold 38. It's now below that range. You can sell 36 again, and you're looking for it now down to 30 and a half. The advantage of doing this and selling 36 again is that now you could scalp that to 30 and a half and go, well, I'll put a bid down there. This does a quick whiz down there. I've still got two. I've covered one down at 30 and a half, and the other two are going to go. They're going to go and do what I want them to do. But you constantly you've got to have that kind of that sort of dialogue with yourself of, well, what should I do now? Where do I really think it's going to go? What exactly is happening, to help you then make that decision about what exactly you are going to do with it. And yeah, these are the sort of frustrations. You saw there's definitely some absorption there. I know we're not on price out a week at the minute, but that's what you're getting. How many days do you watch the 60-minute chart? I'm assuming you don't mean in frequency, as in I would watch the 60-minute chart. That's my starting point every day. From a 60-minute chart, like how many days am I looking back? Predominantly, I'm looking to the most recent low and the most recent high. So that's about as far as I'm going. So if you're looking at the S&P, it's now the low from, what was it, the 23rd, and the high from the 17th. They're the two levels that matter to me. I might go and look at what happened before it got to the high at 17, but broadly that's about as far as I'm looking, at least for any levels. If you're looking at any market on a day-to-day basis, S&P, but whatever it is, you know the basic pattern of what's happened. I couldn't tell you price levels precisely, but I could draw you an S&P chart over probably the last 3-4 weeks, roughly, of at least the structure of what's happened. That's the bit that you need to know. The chart can tell you the precise prices, but you need to know roughly what is done along the way. If you know that, you kind of already know the sort of what I call a story of what's been going on, at which point you're quite clear on everything you want to do. And you get that just by watching every day. Right, so there you go. It's picked up a bit of speed. It's got down to 30 and a half. It's straight through there. That's good news. So if you have just covered, you might now be regretting that, which is part of the point. Or you're looking again, that's fine. It's got through 30 and a half. But note now, it bounces back and it holds 30 and a half again. So this is the point there. Well, and you got to think, what would somebody else do? Somebody else might be looking at this and saying to themselves, if you get back into that zone, I'm going to sell it and use that as your zone to add on. There's a lot of different ways to skin your cat, as the phrase always was, at least. Sell 30 and a half. The goal then is still you're looking for a break of lows. If it breaks the low, we're all good. I'm not going to spend the rest of the day going through all of this bit, but that would be the next bit of the decision. For me, this is the key. Well, so maybe we'll run it a little bit further. This is kind of your key moment. You've had the low, you've had the pullback. If it's going to go lower, it has to stay below this low as it is at the moment. If it stays below there, this is good. We're going down. If it comes back above there, and probably most importantly, if you're considering a stop on the trade rather than just a confirmation, if you're considering a stop, I'd have my stop there now. i.e. if it breaks the low, I want to make sure that any pullback isn't just a pullback into the little range, it's genuinely a turn. If you're looking to play a long because you don't think this really is going down, then anything that comes back above 27.5 is pretty fair game to play as a buy. And you could do that particularly as delta is going up. So if you're looking at it from that perspective, you go, right, fine, we're through there now. If it gets back above 27.5, I'm free to play this back to the upside. If you're of the view that this is going down, so this would be the example of my perspective on it. My perspective on it is this is going down. I'm 10 ticks on side or so. There's still another 12 to go. I want to make sure I give it the chance to do that, in which case I get my stop back at 31. Yes, if it goes wrong, you're only taking a 7 tick winner. But if this goes right, you're taking 20 plus. That's what you're really looking for. So accept that you're only going to get a 7 tick winner on it if it goes wrong, which at the end of the day is still 7 ticks and you're wrong and you've still got paid. So look at it like that.
Sounds quite nice job.
Yeah, exactly. And yeah, if you like the idea of being long, personally I don't from here. I think it's a bit of a dubious place to be long. But as a trade, so forget the overall picture, if you fancy being long and you buy the break of 27.5, you've got a pretty straightforward stop through the low of the day. So you're taking a 4 tick risk. This could be the low of the day and you're at least going 10 ticks back. If it gets above 38, you're back into the range. And then you've got the bigger move as well.
Just one last question on delta.
Go for it.
Do you track support and resistance lines on the delta as it breaks for previous?
I don't know. I don't necessarily draw support and resistance lines, but I'm conscious of, let's say this would be the low of the day in delta at the time, which also matched the low of the day in price. So that becomes a reference, but I'd relate it to price. So if price goes lower, I would expect delta to be lower than here, and it's not, which is to me the indication that people are more inclined to buy.
I think it's dangerous to put on levels where you think, okay, if it breaks this level, you know, for example, the bottom of that delta is flashed down, you clearly you've got the
Here.
and then draw a line straight across, or to the top of the break.
There.
So any break of that, or further ahead, would that validate a move to you, or would it be false to do that because you'd have an expectation of it and think, right, and your bias is low, and it doesn't happen, you come offside.
Yeah, I've never looked at it like that. Partly because the people creating the lower delta here, the sellers, are not necessarily the same people creating the buying here.
Yeah.
Whereas with a level, the people selling it on the break of the level, some of those people you can be confident, because, well, certainly from my point of view, I would be one of them, are the people buying it back through the level. So there's the same relationship, whereas I don't think there's necessarily the same relationship.
Because delta doesn't reflect. You can
Price.
negative delta and buyers and positive delta and sellers.
Yes. Well, yeah, because for every buyer there's a seller.
Yeah.
It's just the action that they're taking. I've always explained it as like selling a car. If I put my car up for sale and I get my car's 20 grand, if you go, I'll give you 20 grand, delta has gone up one because you've met my offer. Yes, there's a buy and a sell there, but I haven't sold it to you. I've told you the price and you paid it. If you come and say, I'll give you 19 and I go, okay, you can have it, then in my view, that's negative delta because I've gone and met your price. So I'm the seller. You've just told me a price you're willing to buy and you've not taken an action to buy. And that's what what is gauging is people's desire to do something. Is my desire to sell the car great enough to take a discount? In which case I'm a more aggressive seller.
Is that when you see the change, in delta statistics, when you see the change in delta, when it's negative 1,000 and then it goes positive, it becomes negative, say, it was negative 1,000 and then positive 200, it becomes negative 200 and then change again, it flips back and forth, positive and negative. Is that how that works?
Essentially, yeah. So if someone sells 1,000
Yeah.
and then somebody buys 200,
It's now negative 200.
then no, it's now negative 800 because there's been 1,000 sold
Yeah.
and then 200 bought at market. So that's now negative 800.
Okay. Right.
If it was 1,000 sold, then 1,000 bought, then that's nothing. Obviously, for every 1,000, so if someone sells 1,000, there has been 1,000 buys, but they're not active. They're just people going bid 1,000 and someone's gone sold. So
I'll show you my charts.
yeah.
I'm not explaining to you.
maybe we'll look on the chart. But yeah, there we go. So I would now be of the view, if I'm in that trade, job done, it's going down. Your stop, if you want to be really tight about it, is above 27. Your stop, if you want to give it a bit of space, is 31. And you're now past the what's it going to do phase, this is either going to work or it's not now. So you kind of move to another decision point. So I hope that's given everyone a bit more of a sort of sense of the approach of actually managing the trade when you're in it, and the sort of thought process behind what you do or and how you do it. Next week, we're going to do a fair bit on profile. I will send the PDF of the exercise. Have a go at it. What I would suggest to do is pick a period of time or a session and go, right, next 2 hours I'm doing it. Because if you, excuse me, if you try and do it all day, it will get mentally very tiring and you'll lose interest in it. You've got to kind of focus. The other thing I would say on it, be very clear and really think through your first entry. The first entry is what's going to dictate essentially how much work you have to do after that point, which is a good way of approaching trading, full stop. Get that first entry right, you're in a good place. And yeah, have a go at it. But have a go at it every day, if you will. You might as well. We'll do profile stuff next week. That's probably my favorite tool of all. I think profile is a wonderful tool. So get onto profile. And we'll do all of that next week. And then we'll finish off with a task on Friday, which is hypothesis building. So I'll see you all next week.
Thank you.
Yeah.